Welcome to the Discretionary Mutual Fund podcast series, an opportunity to dive deeper into the information already shared about setting up a DMF to replace traditional insurance for the apple and pear industry. My name is Richelle Zealley, and I'm joined today by Justin Niven, Managing Director of KJ Risk Group and DMF Specialist. Today we will discuss the structure of insurance and how risks are covered. Justin, there are a number of layers of risks in insurance. Can you explain a little about each of these layers and provide an example showing how they might actually work?
I think the best place to start here in speaking about these risks is to come back to a comment from our earlier podcast, which was in and around the DMF feasibility study and the data that we collected. As a group across the 40 or so growers that contributed their data, we had a little bit over $4 million in premium and around 1.2 to 1.3 million in average claims in any 1 year. If we take a step back and we think about risk for a moment, most of you will be familiar with the concept of a deductible or an excess. They sit on your insurance policies. We refer to that as the self-insurance layer. So basically I'm responsible for the first, say, $5,000 of a property loss if I have a claim at my farm. So that is the self-insured retention. The next layer is what's called the working layer of losses. This is the layer of risk where all of the day-to-day losses occur, the normal losses. So the best way to think about these things are all of those losses that aren't catastrophes, because the next layer of risk is in fact called the catastrophic risk layer. For those of you who want to find a simple explanation for that, that's a bushfire. I mean, that would be the most obvious and relevant one to us all. Bushfire exposure, natural catastrophes, weather events, those types of things. So everything that's not a catastrophe we would consider to be a working loss. So it could be an equipment breakdown, minor property claim damage or hail damage. That's relatively minor. And then once it gets to a catastrophic loss, it has a different categorization. In the loss data that we collected, within that $1.3 million average was a huge catastrophic loss, in fact, in WA from a bushfire. And when you back that catastrophic loss out of the APAL data, the actual annual average for working losses is between 500 and 800,000, somewhere in that range. So as a group, you actually have very few, both a number and severity, volume of working losses. I would have expected to see more, but it's actually very good news because it means your business is profitable from an insurance perspective. And when you're looking to set up a self-insurance solution, you need to have that present. But back to the risk layers. We obviously have catastrophic risk that sits above the working layer, and above the catastrophic risk, you have uninsured risk exposures. A perfect example of this is what we're all going through right now with COVID. Most insurance policies don't respond to this pandemic. It wasn't conceived of when the policies were drafted, and so they don't respond. And the losses from it, as everybody is well aware, are astronomical. So if it was covered, the insurers would be bankrupt anyway, because it is just such a big risk, it basically can't be insured. So those are the different layers of risk. And if we come back to, in an operational discretionary mutual fund, what are we trying to achieve? We want to take the working layer of losses and we want to put that into a mutual. We want the catastrophic risk to still be insured because we don't want to bear the risk for the bushfires and so forth. We still want an insurer to take that risk, but we want to take that sweet spot somewhere between the 1.3 million in claims and the $4 million of premium and capture some of that profit for ourselves.
As I understand it, the DMF will replace a traditional insurance broker and take control of that primary layer of risk. And all members will then pay their annual contribution as they currently do a premium. Providing the claims from the collective group in any given year are lower than the aggregate, we will then achieve a surplus. What are some of the ways that this surplus can be spent? And is there an option to just pay a dividend back to each of the members?
So to answer the last question first, the mutual can't pay a dividend, in inverted commas, otherwise it would be classified as what's called a managed investment scheme. But the good news is we can still return money to members, you just need to do it in different ways. The first way that you can do it is by giving them a reduction on next year's premium. It's the same as giving them the cash back, it just reduces their expense in the next year. The second way, which is one of the most optimal, is to invest in risk management. So if we can find an initiative or a thing that, say, all of the businesses could benefit from, we could subsidize it at the mutual level and thus improve everybody's risk. And then hopefully our claims go down and we make more money. It's a virtuous cycle. The mutual can also smooth cost. So in an environment such as we have today, We've suffered through the bushfires in the past 12 months. There's a hardening insurance market. There's a very real expectation that all of our growers out there are going to face increased insurance expenses over the next 12 months. And as we come into 30 June of this year, particularly with COVID, I think it's going to be a difficult renewal for a lot of you. Within the mutual, if the mutual has surplus money and there is a cost increase, if we have enough, we can actually pay that increase on behalf of the members to keep their costs flat in a difficult time. Ultimately, that cost has to be passed on at some point, but that's the way a mutual actually smooths cost for members. So those are the primary ways in which you would utilize a surplus to give money back to members. The fourth and final way that surpluses should be utilized is actually to be held onto by the mutual to build up retained earnings, because you do have a rainy day and sometimes you need, a rainy day fund sitting there.
You've spoken a couple of times about the hardening insurance market. How will that impact a DMF structure?
In a DMF structure, we are primarily self-insured. As I said before, what you claim today, you pay tomorrow. So if we have an aggregate that we've established from all of the member contributions and our claims fall within our aggregate every year, that means we will get a surplus every year. That means we're making a profit for members. We will have very stable insurance costs pricing if that is the case. If we happen to have a lot of catastrophes and that aggregate is expended each year, we will face increasing cost pressures because that's the nature of the beast. You have more claims, you have to pay more. But the thing that a mutual does is it takes you out of the primary insurance market. So you're not a part of the broader insurance market cycles. You are really just paying to cover your cost of claims in an ideal scenario. We still need insurance. So there's still insurance at the catastrophic layer, what we call excess of loss insurance. So we're still exposed to the insurance market, but to a much smaller extent.
Thank you so much for your time today, Justin. It's actually really exciting to think of the possibilities associated with setting up this long-term investment opportunity for the industry. There's some visuals available on the APAL website and also in the autumn edition of AFG magazine for anyone that would like to actually visually see what those insurance layers of risk actually look like. And if you would like some more information about participating in the DMF, please get in touch with the APAL team or click the link associated with this podcast.